Welcome to the Andrew Holland Podcast, where we explore the stories of successful people, get insight and advice from individuals who have accomplished amazing things, and dive deep into understanding ourselves as human beings. Now, here's your host, Andrew Holland.
Hello, everyone, and welcome to another episode of the Andrew Holland Podcast. Joining me today is Walter Clarke, the owner and founder of Family CFO, a firm that focuses on helping families navigate some of the issues that arise when you fall into sudden wealth, whether it's divorce, stock options from a technology company going public, whatever the case may be. And he recently released the book, The Big Risk, and he gave me a couple copies this morning. I also ordered one on Amazon. I'm excited to read it. Walter, welcome to the Andrew Holland Podcast, and thank you so much for being here today.
Yeah, thank you for having me. Super excited.
So you have a very storied entrepreneurial journey. You've been in the investment services industry for 20, 30 years, and you've seen a lot of volatility in that industry because you were really in the midst of it during the 2008 financial crisis. So we want to hear and learn everything that you learned being in that industry, which was really interesting because obviously Bernie Madoff was the huge talk there. But before we do that, take us back. Give us some insight into your history. Where were you born and raised? How did you become an entrepreneur? How did you know? When did you know you were an entrepreneur? I always like to get the history of when did you discover, okay, I'm an entrepreneur at heart. Give us some of that background.
You know, I think it started with my mom. She was a waitress for many years, and somewhere along the lines wanted to do something different. So she decided, after being a waitress for a lot of years, that she wanted to become a financial advisor, which, you know, it's kind of unheard of when it's a woman and be a financial advisor out of the skill set of being a waitress.
Yeah.
And so she just took it on, and I just watched that journey. I watched her tenacity. I watched how she navigated that and all the different landmines and potholes and setbacks. And so that was really kind of the catalyst that you could just really do anything. She was very successful. And
where were you guys living at the time?
We were in the Bay Area.
Okay, so California.
She took on and working for an investment firm in San Francisco, which is a brutally difficult place to crack in. But she had tenacity, and she was, you know, tenacity and consistency were the two skill sets that she just, you know, demonstrated, and it really kind of taught me that, you know, you have those two things, you can do amazing things.
I love that transition from waitress to financial advisor. Really does prove you can do anything you want if you put your mind to. I think the biggest limiting factor for anybody is this. I mean, it really is this, but if you have a mindset that you can do it, as your mom proved, you can do it. So you saw this. How old were you when she kind of made that switch?
So I was in my teens. So
okay.
The other thing too is that in the financial business, you would think that you'd have to have these degrees and these finance degrees and all this stuff. She had none of that. But she had tenacity and consistency, and she was great with people as well. So she knew what to do, and she had some mentors and she followed directions, and, you know, there's a path. She just emulated herself successful people. She looked at people that were in the business who were successful, and so she said, "What do you do?" And they told her, and she just did what they told her to do, which is such a simple formula, but oftentimes it's just people just don't do it for whatever reason, fear or whatever, their own internal inadequacies, but she just, again, was super tenacious about those things.
Yeah, and I think it very likely she came across with a genuine authenticity that you have to have, and people can feel whether it's there or not, which is no doubt why she was so successful. Did she work for a firm first and then start her own, or give us some insight on?
Yeah, no, she worked for a big firm.
Okay.
You know, back then, and it always did that, always worked for a firm, but just, you know, just super successful in her ability to reach people, connect with people, and to get time with people.
Yeah.
That were busy. I mean,
and in the Bay Area, I mean, that's kind of like a technology hub. So I can, you know, I think about how challenging it can be anywhere, but now you have an area like that is very competitive, and you're talking about significant amounts of wealth, I imagine. And I imagine there are lots of financial advisors in that area who have been there for a while, perhaps generational families and financial advisors. How did she, you've given us a little insight, but let's say someone wanted to do that. How did she break in? What did she do?
Well, I don't know where she got the idea, but she did this thing. Because she would always tell me that you got to create relationships with people, and so she would do this thing called Faces in the News, and so she'd look through all these articles, business journals and magazines and things like that, and she would identify people that were up to big things and
Mm-hmm.
doing amazing things, and so she would cut the article out, and then she'd laminate it, and then she put like my mom's kind of whimsical, so she put all these stickies and high fives and stars and all this stuff, kind of corny, but she then send that to them, and then she'd follow up with a phone call, and it was such a personal thing
Yeah.
that oftentimes she'd get through, and she just says, I just want to have coffee with you and get to know you, and then she would do that, and that was the icebreaker, and incredibly effective, and the people that she got in front of. And so when what I learned is when you connect with people at their level, and you do things differently, and you do things that show them that you care, you know, that article that's in the business journal. So probably 50 people call
Mm-hmm.
to try to get through, but she's the only one that, takes the time to do a laminate, put stickers on it. Hey, you're awesome. Things like that.
Yeah.
And she was the one that got the appointment. So that was that was her gig. And it was just incredibly successful.
Yeah. I mean, I think that's brilliant. Because in that industry, and for anybody that's been in that industry, you have to find a way to differentiate yourself from the other 100 people that are calling you. So whether it's corny, whimsical, whatever, it's worked. And talk about brilliance. You saw her do this. You saw the tenacity that was required to grow her book of business. In the firm that she was in, when she grew her book of business, her clientele, did she own that, or was it kind of the firm's? What I'm saying is, had she wanted to open up her own firm, not that you necessarily want to, because there's a lot of regulations there, and you and I will have a deep conversation about that, just because from an entrepreneurial perspective, it's so fascinating. Or what was the model there?
Well, I'm not really sure, but I think it would, in the client world, she would have owned those, and if
Okay.
she wanted to do something different, she could have.
Yep.
She had the relationship with the people. The firm was just sort of the umbrella that she plugged into, that where she was able to offer the products and services
Yeah.
that they did. She was more insurance driven, life insurance,
Okay.
disability, those kinds of things. So she always worked for a fairly good sized insurance company.
Okay. So less on the stock investing and
Right.
bonds and doing the 60/40. You saw all this. Did you know at a certain age, this is what I want to do? I see what my mom's doing. I see how successful she has become through her own work. This is what I want to do for the rest of my life. Or how did you come into the financial services industry for yourself?
Well, I started my career actually in real estate
Okay.
and commercial real estate. And so I had a roommate who started at Merrill Lynch. And so what I learned in that sort of scenario and that sort of comparison is I was in the transactional business
Mm-hmm.
and he was in the residual revenue business. And so I watched the comparison of how hard I worked, and you have to make a sale and you earn a commission, and then you have to do it all over again, where he gathered these clients and had a more of a consulting relationship with them. He made a lot less initially, but then, I watched that, and it was very intriguing to me. And then I also got to see how he interacted with people, and the effect he had in their lives, and the impact. And so after a number of years, I transitioned from commercial real estate into financials. And it was really seeing the different economic models, and then also, and then watching my mom and knowing that I could do that. I didn't finish college. I didn't have a college degree. I didn't have
Mm-hmm.
these sort of things that you would think that you would need. But I was in my early 30s, and so anyway.
I think what you just said there, Walter, is a really important point that we need to spend a little bit of time on, or at least pause to discuss. You shared advice through your experience that a lot of entrepreneurs don't think about, and that's the economic model. Sure, you hear the revenue model, But what you said is, okay, I was in real estate and your friend was in the financial services industry. Each of the transactions you did were one and done. That doesn't, not to say you can't grow a relationship with someone that maybe flips properties or what have you. Whereas your friend was taking a little bit of a longer haul, growing these relationships, but they were residual revenue, recurring revenue. And that's something I learned the hard way or never thought about as an entrepreneur. And you would think, okay, if you're going to start a business, where does your money come from? Well, sure, you think about that, but you don't really think about, if you're in real estate, oh, I'm going to sell this house and this house and this house and this house, and I'm going to get this commission. Okay, but are you building long-term value doing that? And I think that's what you hit on and what you saw from what your friend was doing versus what you were doing. That's not to say you can't build long-term value in the real estate industry, but that transactional type of business versus residual type of business is something that if you are thinking about starting a business, or maybe you're in a business and you haven't hammered down what type of business do I want to be in, you should give it a second thought. Because in my own experiences, all the businesses that I've had the most, I don't want to say enjoyment, but where I felt really good with the economic model were the residual ones. And I've been in both. So it's fascinating that you got the chance to see that and you decided, you know what? I'm going to make that switch. So you made that switch. About how old were you? It's not that you didn't like real estate, right?
No, I mean real estate, but it was just it for me, and I have a lot of friends in commercial real estate. They've built some really amazing careers, but it was just kind of a dog eat dog.
Yeah.
You're only as good as your last transaction, and there wasn't a lot of loyalty, and it's whoever brought the deal or the lease or the building, or and it just
And this is in the Bay Area, right?
no, this was actually in Phoenix. I moved to
Okay.
Phoenix in '85,
Okay.
and so
And why Phoenix? How did you get from the Bay Area to Phoenix? Family or friends or just on a whim?
it was just a conference I went to, and Phoenix is very recreational, and I've always been somebody that enjoys the outdoors and running, hiking, biking, and all that stuff. And so I just had an appeal, and I was in my early 20s and wanted to make a change, and so I moved out here, and so, but my friend, he just had, I watched him in his interaction. I watched how he affected clients. I watched the economic model. He made far less money initially than I did, but then there was this inflection point where his residual revenue was just, and then he started working part-time, and he'd go in the office at 8 and leave at 1, and it was I went, wow, it's an interesting thing to think about, the transactional side versus the recurring side. And so I got to witness it. I got to live it on one side, and then I began to have some more friends in financial services, and started talking to my mom about it. And so anyway, it just became, this is what I want for my life. I want to have impact with people. I want to be able to have economic freedom. I want to be able to have time freedom. You can work really anywhere. I mean, remote work then wasn't a thing, but you could definitely do that.
What time frame are we talking right now?
You're in the kind of the 96 to era and above.
Yep. Okay.
And so internet was just kind of percolating.
Yep.
And so lots of good stuff.
Okay, so you decide you're going to make the switch. Tell us, did you join a firm? Did you give us some insight onto how you plowed into the financial services industry?
So my friend was with Merrill Lynch, and he said, I think you would be great at Merrill Lynch. And so that's what I did. And I went to work for Merrill Lynch in 1995.
Okay. And give us the history of, so Walter and I have talked about his stories that, having been in the financial services industry on the banking side for many years, I'm fascinated with, and I think you will as well, just because of the volatility and the entrepreneurial things you learned through your experience in 2007, 2008, 2009. So we're trying to lead up to that time point. So you get in about 96 and take us through to what we'll spend a lot of time on, kind of all of your experiences with SEC and everything in 2007, 2008.
Yeah. So I started at Merrill, and I moved different companies. I did Merrill, and then I went to Piper Jaffray, and then I was with a company called Wachovia Securities. And each time I moved, I was trying to gain a little bit more flexibility. I was trying to gain some greater depth in products and so forth. And then in 2003, I started my own firm. I started a fee-based RIA called Oxford Investment Partners in 2003. So I had 3 firms from 95 to 2003, and I think about April of 23, that's when Oxford started. But what really was an interesting catalyst is I developed a teaching program that kind of catered to this sudden wealth movement, and that started back in 1999. So that was kind of the driver, where my mom's was this Faces in the News, teaching and educating people that come into sudden wealth became the catalyst for gaining an introduction. And, what are your problems? What are you trying to accomplish? What are your fears? And really at that time in 99, there was no place for somebody to go and learn without being sold. So what would happen, and this actually was a situation that happened with a local iconic car dealer back in the late 90s. This is a guy by the name of Lou Grubb. And Lou Grubb owned lots of dealerships, and he was kind of a folksy guy. But what happened for Lou is he had a liquidity event. And so he sold his car dealers for, $100 million. And so I remember having lunch with him. Lou was a very approachable guy. If you called him up and said, "Hey, Lou, I'd like to have lunch," he'd have lunch with you. He's really an incredible guy.
Was he one of your clients at the time or no? Okay.
No, I just knew him from some other things.
Yep.
And so I said, "Hey, you must be, on top of the world." And he said, "Absolutely." He said, "I'm not." He said, "Because I got everybody coming at me. I got Merrill Lynch, I got Morgan Stanley, I got all these firms, I got the banks, I got just everybody wants to sell me." And it was really frustrating. He said, I don't know the first thing about finance." And he goes, "I walk into these meetings and he said they deal in these terminologies that I just don't understand. And so I don't want to raise my hand and say, what's duration? What does that mean?
Yeah.
What's a credit rating?"
Yeah.
And so he was just really frustrated. And so I thought I seized that as an opportunity. And I said, "Wow, that's interesting." And so me and another guy, we got together and we started writing this class that we wanted it to be purely academic. We didn't want there to be a sales pitch. We just wanted to say, here's how the game works. And so
that's how you stumbled into this model. You kept your eyes open.
Yeah.
And you were working at a firm, but you saw, and Lou was kind of the start of this.
Yeah. And he was really kind of the catalyst. He's like, "Hey, here's what you need to do. You need to structure it in this way. Don't make any assumptions about what I know, and teach to me like I'm a third grade. I know everything there is to know about the car business, but I know nothing about the financial business. And so you need to elevate my understanding so I can then determine how I want to interact with the community."
That, whether you realize that or not, Walter, that is such a motivating story, because I have tons of people that come to me and say, "I'm an entrepreneur, but I'm stuck in the corporate world and I don't know what to do." And they're afraid and all. You just pointed out you're in financial services, which some people will say has become commoditized. They're everywhere, but you saw an opportunity. You're still working for someone, but you're keeping your eyes and ears open. And now you're establishing the groundwork for your registered investment advisor. He said RIA before, if you're not familiar with that term. You're establishing the philosophy of the entity that you will eventually start in 2003. I love hearing those stories, because anybody that feels like they're stuck in the corporate world or they can't, just keep your eyes and ears open, just like you did. And you saw this opportunity. You said, "Okay, how can I solve it for this individual?" And then you started working on it. It didn't happen overnight, right? You said you started this in 99 and you didn't go independent until 2003. So it took 4 years of you building on this philosophy, correct?
Yeah. It took us a year to write the class.
Okay.
And then what was fascinating was we knew we wanted an academic partner, because we didn't want it to be the free steak dinner and come to Ruth Chris and we'll buy you dinner. And we wanted it to be longer. It was going to be 3 hours once a week for 7 weeks. So it was really a commitment to.
And you weren't trying to sell them anything.
Right. And so we went to ASU and said, "Hey, we have this material and we think that you would be a great partner of ours." And so we went through this really long period of due diligence and finally got to the point with ASU, and they're just like, "We're not really sure whether or not we want to do this. There's financial risk. What if you talk about you should buy gold, or, what if people sue you because they construe some advice, or, they were just really, really afraid of it." And so it was so funny. I had lunch again with Lou and he's like, "So how's it going with the class?" And I said, "Well, we're kind of in an impasse." And I said, I just I don't know what to do. And he said, I'll help you. And so at the time, the president of ASU was a guy by the name of Laddie Core. And so Lou was really good friends with Laddie Core, and he called him and said, you need to teach this and you need to do this. And here's why, because I'm your student and I want to see this happen. And so there that was. And so Lou made a call, and forever grateful for him for doing that. And that set us on this, this odyssey of this program that we continue to teach today.
That's such a cool story, Walter. It's not about what you know, it's who you know and building those relationships. And you took an interest in Lou in a completely different way than everybody. Everybody just saw him as he's wealthy. How can I get a piece of it? That's all they saw. But if you take the long-term game and you just set aside all of the money and the revenue, which is oftentimes everybody's focus, and you just look at the individual as a human and say, okay, how can I help you as a human? The rest will come. And I want to talk more about that in a bit. So you guys get the class going. ASU, the president basically says yes because Lou gave him a call. Is Lou still around today?
No,
He's not. Okay, so he passed away. You get the class going. How does it go? How is it taught? Give us some insight there.
yeah, the class was a struggle in the beginning. To teach to people that come into wealth is different than teaching to undergrads or graduates. So we really struggled initially. What are we going to teach? How are we going to teach it? Examples. I was horrible instructor, but it's one of those things that you got to skin your knees and skin your elbows to try. The feedback was decent, but it was hard.
And was this a class that did you have to be a student at ASU to go to?
No, we were targeting the Lou Grubbs of the world. We were targeting people that had an economic event in their lives, whereby they had all of a sudden this newfound chunk of money, and they were sort of ill-equipped to deal with it. So that comes about in a number of different ways. So that was our audience. It wasn't grads. It was people that already had money.
And how did they find you? So let's say I'm an entrepreneur and I sold my business. My first thought isn't, oh, let's see if there's something out there to help me with this at a campus. So how did you market to these individuals?
We just did direct mail.
Okay.
And so we did a very academic piece, kind of talking about the duration. It cost. There was a cost. It wasn't free. I don't remember what it was, $1,000 or something. And it was the cost and the duration. So we ended up getting a very dynamic audience, and we have over the years. And it's kind of fascinating who shows up and why. But there just isn't in the financial business. There just isn't, pure education. There's typically a hook somewhere.
Yep.
And so we were, we prided ourselves that we weren't those guys.
So a natural progression, if you're just teaching someone, and this is where, if you think about the long-term game, not that that's your ulterior motive up front, you just want to educate. But as you build a relationship with these students, people that have gone through these events, you're building trust. And of course, a natural thought process, if I'm sitting there and learning from you, Walter, is, what can you do this for me? Can you help me do this? Because I learned, and now I can understand when you and I are sitting down and you're saying, well, have you thought about this type of portfolio, or have you thought about investing in this way? Is that how you ultimately started your RIA? Is that why you ultimately started your IRA? Or tell us how that progressed.
Yeah, I mean, you build these relationships with people, but you build them very differently, because you look at your class and you see your roster and you're like, holy cow, there's some really big guys in here. And so
was that intimidating to you?
It's not the size. What was intimidating for me is I taught a class for 6 years at up in the Bay Area at UC Berkeley.
Okay.
And I would see the CVs on some of these people, and that would be very intimidating. I'd have, MDs from Harvard. I mean, I'm a guy that didn't graduate college. And so now I'm teaching and we had some private equity people. I mean, we had some investment bankers in finance come to the class, and I'm like, oh my God, I'm going to get crushed. They know so much more than me, but it was interesting, dynamic with them. But yeah, you build these relationships and you really try to help, like, where are you trying to go and what do you want to do? And then as you do that, you just become so much more attractive to them, because everybody else is coming at them in a very different way. They see their wealth and like, oh, I got this solution, or I can do this for you. And we just never tried to do that. We were just like, where are the holes for you? And how can we help you become better educated, so you can make better decisions. One of probably the greatest examples, we had a guy come in, I'll never forget. He wanted to meet with me in the class, and I said, just jot your email down, and send we'll meet. And his email was Paul, just Paul, not Paul dot, not Paul last name, just Paul at google.com. And I looked at him and I'm like, oh, that's pretty funny. And I said, so how early are you? And he goes, I'm employee number 21. And it was fascinating.
Wow.
It was fascinating. He was 30 years old, something like that. And he just said, man, I got everybody coming at me. Just Google just went public. Now my financial needs are very different. And he said something I'll never forget. He just said, show me behind the curtain. Just show me how show me how the game's played, how people are paid, motivation, all those things. And he said, then I'll then know how I want to structure my own situation. So just give it all. Don't pigeon me this way. 'Cause that's what happens for people is it's like, pick a card. It's like, they'll educate you in a way that's going to get you there. And we just didn't do that. Some people are self-directed. They want to handle things themselves. They don't want to use an advisor. And there's tons and tons of companies that offer things self-directed. And then there's obviously the advice side, so we don't say either one. We just say, here's do it yourself side. Here's what you need to understand. And then here's the advice side. Here's what you need to understand. And you get to kind of choose how you want to play the game. And so we just did that. And he just he couldn't find that. He couldn't find a place where he could go. 'Cause he said, you go to Merrill Lynch and they say, we're the best. And then you go to Bank of America and then they go, Merrill's terrible. And Bank of America is, and it's just this confusing when you're uneducated. You just don't know.
How can you know?
Yeah.
And it's all transactional based for a lot of those firms. It's all about the next one and the next one. And once they've wooed you, and then they've brought you in, okay, now they do the same thing to all these other people. It is no surprise to me that you were wildly successful with this class. You still run it today?
Yes.
Are you still teaching it? Do you have other people helping? How does that work?
So no, we've licensed it and we've had other people teach over the years. I'm actually doing a program in May 17th. It's a 1 day. We're doing it up in Santa Clara.
Okay.
Because we typically teach in areas where there's a lot of percolation. So obviously NVIDIA and Apple and everything that's cooking in Silicon Valley. So we'll plop ourselves down there and just be of service. Again, I mean,
and you do all that through Family CFO, under the Family CFO name.
Correct.
Okay, so 2003 comes along. You've been teaching the class for plus or minus 4 years. Is that right?
Yeah.
How do you decide to start your RIA? And what was the name of your RIA at the time?
It's called Oxford Investment Partners.
Okay, so you start that because there's a need. People want to give. I imagine people that don't want to go the self-directed route want to work with you because you've built this trust relationship, and just being honest with them and opening the door of what options are out there. I'm not telling you have to go this way or have to go this way, but here's what available. And I love that. Show me behind the curtain. I wish that in so many industries, whether I go in to buy a vehicle at a dealership, I always wonder, I wish I knew what are the motivations of that person sitting across me behind the desk, because they have them. And it's impacting their behavior, and it's impacting the things they're telling me. And they view me, I walk in, and they automatically have a first impression. And just like you said happens in the financial service world, they're going to pigeonhole you into one of the 10 buckets that or caricatures they've determined about people. And that's going to affect every single one of their behaviors. And when you don't know, and I'm just using the car industry as an example, but when you don't know what those are, you have a wall up. And that's natural. And that's never more prevalent than in the financial services industry. So I love this philosophy that you came up with. And I wish every single industry, whether it's buying a house or building a house with a contractor, it doesn't matter what it is. You start this firm, Oxford Investments. Tell us how that progressed. You're obviously, you had to get your Series 7 or Series 63 or some of those things.
Yeah, so we had to go through all the licensing. But the catalyst for Oxford was I wanted greater flexibility in terms of products. The clients that we were working with at the time were bigger. And what people don't understand, and we educate in our class, as you move up the sort of wealth scale, you are afforded different product options at different pricing.
Yep.
And most people don't know that. And so we wanted, because when you're inside of a firm, you really can only sell firm products or firm sponsored products. You can't go out if somebody brings let's say you want to go out and buy an apartment, or you want to do things direct. You can't, as an advisor inside of a firm, you can't do that.
Yeah, because it has it. So I'm just make this up. I work for XYZ, Merrill Lynch, Goldman, blah, blah, blah. They have all these products that are firm sponsored or that they've approved for whatever the regulatory reasons. And that model makes a lot of sense for risk and what have you. But you might not be able to, like you said, see a multifamily property down the street and you as an advisor be able to help your client get that or offer that under the firm, so you can't do it. That's what you're kind of talking about.
Correct. I just wanted greater autonomy based on different things that I may or may not find.
Okay.
And so having an RA gave me that flexibility to do that.
Okay, so you start the firm, and the name of the game there, if you will, is, I mean, you do have to raise capital. You have to, whether it's 100 million under management or 500 million under management, it was fee-based, you said, correct?
Correct.
So 50 basis points, whatever, everybody has different models. That's kind of shifting now. I don't know. The fee-based model in that industry, and correct me if I'm wrong, seems to be less and less attractive, and now it's moving in a different direction. Would you say that's a fair assessment?
I don't know. I mean, the fee-based model is, I go to conferences all the time. We personally in the class, we talk about the fee-based model, but it's at certain points in the wealth scale, that model needs to transition to what we call a hard dollar fee. And most families just don't get that. And what I mean by that is that, by way of an example, if you have $1 million account and you charge 1%, it's 10 grand a year. If it's a $10 million account, and so let's say your percentage is lower, so maybe it's 0.7 versus 1%. Well, the $10 million guy is going to pay $70,000 a year in fees, and the $1 million guy is going to pay $10,000. Is there 7 times more work in a $10 million account than a $1 million account? And our argument is there isn't. It's the same. And so hard dollar fees are not getting the kind of traction that they should be getting in the financial industry, because the AUM model is just the AUM model.
Yeah.
And so people just don't know.
AUM, assets under management.
Yeah. People just don't know to ask, and they don't know how to negotiate. But that's one of the things that we do in our firm is we hire investment guys. And we're very familiar with the fee schedule and what they need to get paid. And so we don't attach it to assets. We attach it to work.
Okay. Which that makes a lot of sense. I understand why, a lot of firms don't want to do that, because like you said, the more assets under management, if we can keep our 1% basis fee, that's how we grow our revenue. But what you're saying, okay, that $10 million family, yeah, they might have a lower base, 70 basis points versus 100, which is 1%. But really they should be going in and saying, you know what, 50,000 every year. That's what, now we can talk about scale. Maybe if it goes up to $50 million, then you can raise it to 100,000. But this percentage thing, as we grow, is not a model that works for me as a family office or as a family. That's kind of what you're saying.
Correct.
Okay. So you're starting Oxford, fee-based model, which is common for a lot of people to start in. I've always found that industry fascinating to see how it's changing and the trends. The fee-based model is very hard to get away, but don't want to spend all the time talking about that. Take us into the success of the firm, kind of how it progressed. Actually, before we do that, were you afraid to start your own firm? Like, you were being this is where you made the transition to an entrepreneur. You started the class, which was very entrepreneurial. And obviously you're charging for the class, but that's by no means, there's certainly upward mobility potential, but it's not necessarily going to give you what you need, or give you the economic freedom and the time freedom that you're looking for. True?
Right.
So you start the firm. What was your mindset at that point in time? Were you terrified to do that? Were you ready to do it? Give us some insight into your psyche.
No, I was just the next.
Okay.
It was the next. It's the next thing.
Okay. So for you, it was a pretty easy thing to do. Take us to 2007, 2008, 2009, some of the stuff you and I talked about in our pre-call, that because of things outside of, I don't want to say fact, but other factors in life that impact situations more than perhaps justice. So politics, money, power, people trying to make a particular point, talking about the SEC in this circumstance. Talk to us about that time period.
Yeah, so I started the firm in '03, and we grew rapidly. I mean, our compounded growth rate was, 32%. And, there's the whole adage, the cobbler's, kids have no shoes. And, I really got drunk on the Kool-Aid of what was happening inside the firm. It's interesting how, personalities and optimism and what I was teaching is financial prudence and all that. But then that just wasn't part of my life. And so we were growing like a weed, and every year was better than the next. And we had this teaching program, and clients were, it was really kind of a fascinating thing. And so, um, in, kind of '07, '08, we bought, you buy a house and you buy a bigger house and you buy a bigger house, and it kind of got caught in that.
Which is
And
very common. I mean, that can happen to all of us. It likely has happened to all of us. That's normal. That's
yeah. And
human.
so really, and based on that, I mean, the firm was incredibly profitable and things were going really well, but I had more debt than I wanted to have. And so really the one asset that I had was the business. And so I thought about selling a portion of my firm, which I did. And I did it to three people. Bought in my mom, a CEO of a public company, and my largest client. And so we kind of checked with the professionals and said, hey, is this something we can do? And really all that. But looking back, it's kind of the title of the book, The Big Risk, is everything that you do has got risk reward associated with that. And so that transaction ended up not turn out so good. And I just did not understand, the kind of environment that I was stepping into, and what could go wrong if we didn't get it right.
Not necessary to any fault of your own, because had your transaction taken place, and I want to dive a little bit deeper so that we can understand exactly the context in which this is happening. Had it happened 4 years ago, no, there would have been no problems. But because of what transpired in 2008, 2009, and Bernie Madoff came out, the SEC had to find heads to take off. I mean, this is not, if you follow anything related to the government or anything of that nature, this is very, very common in politics. All the Sam Bankman-Friedman is the most recent one. All of these legislatures were deep in bed with Sam Bankman-Friedman. He was giving donations, and then it all blows up, and then they all want a distance, and then they're going to make a showcase out of this particular person. This tale is as old as the test of time. And not only does the big fish get hurt, but all the other people who perhaps were more innocent, not doing anything fraudulently wrong or aggressively wrong, well, they get their head chopped off in the whole tidal wave of, well, we got to make a big deal out of this. So that's essentially what happened to you.
Well, I mean, we clearly we did some things incorrectly that opened ourselves up to regulatory scrutiny. And so, I, for the longest time, had a lot of heartburn, with the regulators, and, what happened to me, and I got screwed, and, my lawyer not doing the transaction correctly. But anytime you go through the shredder, if you don't have the ability to go back and look at it and go, okay, what did I do to set the ball rolling? Where was I wrong? You got to take personal responsibility for it. And if you don't, you're destined to, I think you're going to repeat it. You're going to live in misery because something outside of you caused you to be where you're at. So you got to, and it took me a long time. It took me a long time to really kind of take ownership. But once I did, there's a tremendous amount of freedom with that. And so taking ownership of, I put myself in a position. I should have never sold a part of my business to a client. I could have gone outside to the outside community and raised capital, and then there would have been no issue. And so anyway, I look at the missteps. I look at, the regulatory environment. Hey, it is what it is. The challenge we had, or I had, was we were audited after we did the transaction, and the regulators had no issue. And then,
so you went through the whole audit process. Yeah. They approved the transaction.
They don't approve anything. They just, if they have an issue with something, they tell you.
Okay.
If they don't have an issue with it, doesn't mean that they're approving it. They just didn't have an issue with it. And so when they came back and did another audit on us after kind of the Madoff, and quite frankly, the SEC was considered to be very soft prior to the kind of the Madoff. So there was a new enforcement guy, and
Mhm.
he just wanted to be a lot tougher. And
Mhm.
and so that doesn't mean that they're bad guys. We made some mistakes, and then those mistakes were compounded by me saying, "Hey, I didn't do anything wrong." I think looking back, there's an epiphany I had one day. I was in doing my deposition at the SEC's office, which is absolutely the scariest place you'd ever want to be.
Where is this, in DC, or where's
No,
the
no, it's in
office?
LA.
It is in
It's
LA.
on Worcester
Okay.
Boulevard. This is building. You never want to go there. You walk into this room and it's like, oh my.
This is the Securities Exchange Commission for everybody listening. So, he went through this transaction, and when you're in this industry as a RIA or anything financially services, obviously the SEC is supposed to be there to protect the public, whether it's for public companies, registered investment firms. There's also other entities, FINRA, but just to give our listeners an idea of the transaction. So you were going to do this transaction, and anybody that owns a firm like that, there's a certain level of due diligence process, all these disclosures required, et cetera, et cetera. I'm by no means expert, but I've been involved in this, having had a hedge fund before. So you go through this, you get a clean bill of health. I'm going to say that. And then Bernie Madoff happens. There's new sheriff in town at the SEC, and they're kind of looking back at all of these transactions. They take a second look at the transaction that you just did, and they now have issues with it. So you're in the midst of this time period, and now you find yourself in the SEC's building in LA under deposition, just setting the stage for everything we're talking about in case you've never been in this world, or what we're talking sounds like, bananas, or that's just kind of the foundation. Okay, so now you're sitting in the SEC, and you said there was a statement that really kind of was an epiphany for you.
Well, it wasn't a statement. It was just an experience that I had.
Okay.
So I'm sitting there and I'm doing my whole thing, and we go to leave, and I'm with my attorney, who's a super expensive firm in LA, and I got it. I'm like, this is what we did wrong. And I said, I want to go back in there and just not fall on the sword, but just say, hey, here's where I think we got it wrong.
Mhm.
And I said, here's what I think we need to do to make it right. And my attorney's like, oh, you can't do that. You can't, I think we're going to win. And I think we're going to beat these guys. And for me, I didn't follow my gut instinct. I just didn't. He's like, you can't do that, and here's all the reasons why. But to me, that for that moment, that brief kind of moment, I'm like, I want to go to those guys and say, hey guys, I get it, and here's what I want to do to make it right. And we just never had that, and I deeply regret that. I wish I would have stopped the whole process and went in and just laid all my cards on the table, because after they were asking me all the questions, because I kept thinking, like, why are they after me? We had no client complaints. The one office had looked at this already and really didn't have an issue with it.
Nobody had lost money. There was nothing of that.
Yeah, I mean, no client complaints, no anything, but they were just really super focused on it.
And this was all around disclosures, right?
Yeah,
that's where this whole case was. Did you properly disclose X, Y, Z?
Yeah, X, Y, and Z, and sort of all that. And did you value? One of the things that they also had an issue with is how I valued the firm. They didn't think that was fair. So they basically were saying I took advantage of this big client of mine, and I was in financial duress and had to sell, and took advantage of her and manipulated her. I mean, she was an incredibly sophisticated person.
Yeah.
And
they're going to press every button they can. I mean, they're trying to win a case. Let's be clear.
Yeah, no question. But I think the message that, if you're listening, is that you got to really trust your gut instincts. Advisors always have an angle. So the attorney, if I go in there and fall on the sword, there's no more fees. Yeah. This is a very, very expensive case, hundreds and hundreds of thousands of dollars in legal fees. And he wanted to run the gamut. And so I wanted to make a business decision. Mm-hmm. I wanted to make a business decision to stop the whole mental, the everything, and say, hey guys, like, how do we work this out? Like, you got bigger fish to fry out there. I want to tell you what I did wrong, and let's figure this out. I wish I would have done that. I mean, that it would have been a very different outcome.
I think you've hit something that is one of the most singular determinations of whether entrepreneurs are successful in almost any situation. And this can happen both personally or professionally. You will always have, it's sad that it was an advisor in this perspective, and I want to talk about that as well, but you will always have people chirping at you, outside influences, telling you this, that, or the other thing. You can go back, I study entrepreneurs. I've talked about the Founders Podcast by David Senra. it only focuses on biographies and autobiographies. All of the great entrepreneurs, Steve Jobs, Henry Ford, Cornelius Vanderbilt, any of them, they built up their gut and then they trusted it in spite of what everybody else is telling them. That's not to say you don't listen to advisors or you don't listen to what they have to say, but at the end of the day, you as an entrepreneur, as an individual, have to trust and listen to your gut. And that's really what you're telling us. That is what you wish you had done in that scenario. Now, we've all been in scenarios where we don't do that. I've done that so many times, Walter. And it takes time. That only comes through experience, right? You can only learn that lesson. You can hear it, but it's very different to hear it and then say, oh, I'm going to do that, than to internalize it and actually do it when it's really, really challenging. So I appreciate you sharing that point, because I think that is something that we're kind of losing in society, is confidence in yourself or in, now you have to hone it. You have to get it from experience. And this, of course, was your experience where you learned, you know what, moving forward, I need to hindsight 2020, right? But that's what the whole podcast is about, learning from each of our experiences and talking about it, because we're all going to make mistakes and have failures. That's the only way you can have success. Your advisors, I want to focus on that, because I think that's a piece that I've had multiple advisors. I've had M&A attorneys on here. I've had CPAs. I think the relationship between an individual, regardless of where they are, and this can be on the personal side, whether it's a psychologist, therapist, wherever it is, or on the professional side, CPAs, whatever you're going through. In your scenario, I think this is what Family CFO helps clients who have fallen into sudden wealth think about, is that is a really precious, important relationship of trust. You have to have that trust, and it has to be well-founded trust with your advisors, so that you know that they are doing what's in your best interest. Because what I heard you say is your advisor was doing what was in his best interest, not what was in your best interest. How do you tell your clients? How do you ferret that out? If you don't know and you come into sudden wealth, let's use that as an example. People know you've come into sudden wealth. These attorneys or the CPAs, the financial advisors that are all berating you know this. How can you know whether you can trust someone so that when they give you advice, in spite of the fact they all have a fiduciary responsibility, set that aside, because that doesn't happen very frequently. How do you know, Walter? What advice can you give us? How could you have known for this particular advisor?
Well, I just think it all comes down to you got to get educated, because in every industry there's educational gaps. There's no perfect scenario that's sort of out there. And so you really have to understand how people are motivated and what their limitations are. And the only way you can get there is you just got to be educated. Mm-hmm. So, yeah, you're a fiduciary, but there's just so many things that you can't do inside financial services. I'll give you an example. Real estate is an incredibly powerful tool that's very underallocated in the wealth area. And the reason for that is because the advisor firms only sell partnerships, but as you move up the wealth scale, partnerships aren't appropriate because of the cost and the control and all the things that go with them.
You're talking about from a legal entity structure. Correct. A partnership isn't
correct.
Appropriate.
So what bigger families do is they buy their own real estate, and they don't have partners, mm-hmm. and they can craft the real estate, but advisors don't sell that. They just don't. They don't have that solution in their toolbox. Yeah, I'm a fiduciary, but I'm a fiduciary that has a limited toolbox. And there's, especially in the bigger families, there's all kinds of depreciation and, mm-hmm. and all kinds of tools that they can use to offset gains in other areas. And there was an advisor I was talking to the other day, and they got this one client's got a big liquidity event, and they're trying to offset all these taxes, and they're mm-hmm. telling me all these strategies. And I'm like, well, what about real estate? And you can do this and do buy something, do a cost segregation study, and that can offset. And here's ways to do that. And they're like, but then our assets leave the platform and we don't get paid. So we're not going to talk about that. So So how do you
That
don't,
is so sad,
you just,
Walter.
you don't know what you don't know. So
Yeah.
our job, and listen, not everybody wants to own a piece of real estate direct, and there's complexity to that, and there's challenges, and just, there's not a perfect solution anywhere.
But to not offer it as a solution when it may be the best solution for our clients, I think that's a breach of fiduciary responsibility. I know it happens a ton. I'm not naive, but that really ticks me off.
Yeah, I mean, it just, again, so you got to understand people's bias.
Yeah.
You really do, and then in order to go against, professional opinions, you got to have courage and conviction.
Yeah.
And by being more educated and talking to more people that not only are not necessarily in the industry, but other wealthy families. I like people to network with other wealthy families to say, okay, what are you doing? What's working? What's not working? And that way you can flush a lot of things to the surface, but it's an ongoing process. The problem that you have is the wealth creators are really good and really passionate about something else. So they move, like, let's say the Google guy,
Mm-hmm.
Paul is one of the greatest software engineers on the planet. But financial was not that's not his primary language.
His expertise is engineering.
Exactly. And really creating things. He's a problem solver in the world of software.
Mm-hmm.
And so, like, this financial thing is not something that kind of turns him on. He needed to do it. And so that's the problem. And so people don't devote the necessary time to getting educated and really understanding how the game's played, so they don't fall into the pothole. What ends up happening is they learn along the way, and they have that moment of a mistake, and they're like, oh, let's not repeat that. Challenge for the bigger families is that becomes a really, really big dollar number.
Yeah. That mistake.
Right. And so that's typically what we see. What we see is you have the second job, and you really got to look at it like a second career and be very serious about it, and get educated. And then you can ultimately decide how you want to play the game.
I want to take a step into your psyche during the time frame that you're going through all of this tumultuous experience with the SEC. I think most people would hear that and they would just, you're getting scrutinized by that, like the Securities Exchange Commission of the United States. Like, that's a big thing for a lot of people to think about. And it relates very closely to being an entrepreneur, in the sense that I don't believe our psyche is intended to be able to handle the volatility that comes with the terrain of being an entrepreneur. And now in your scenario, you add on this huge, legal or tumultuous situation that you're being heavily scrutinized for. How did you, Walter, handle the emotional and mental volatility that came with that terrain?
Oh, man, that's a great question. It kind of takes me back. So there were so many other things that were happening in addition to the SEC. So we, as a firm, we had a pretty significant chunk of money in real estate loans that were all going bad. And then we had one company that had been an iconic company in Arizona for a lot of years, called Mortgages Limited. And back in 2000, late 2008, not the founder, but the son of the founder, committed suicide. And so Scott Cole killed himself, and he basically threw this whole company into this complete disarray. So we had that going on. We had the SEC going on. We were in a market segment that was just getting annihilated. And so it was interesting. You kind of figure out who you are when you're in it. And so I'm the kind of person, I handle pressure really well, but I slow everything down. And it's like, okay, what do I need to do today? I mean, like, I'm not going to talk about 6 months from now, but when you're in it, you can either, play poor me, or you can get into action. And so it was like every day I felt like I was running in the mud. And then the SEC thing, it seemed real and it didn't seem real. Like, we were audited once before and we had no complaints. And so I looked at that like, okay, we're just going to go through this and they're going to really, be in us, but there's really not going to be any significant consequences here. And so I just didn't think. It was stressful, but I kept asking people, like, okay, what's the end game? Like, what do I deal with this? And
because you wanted answers.
Yeah. Like, you
want certainty.
Yeah. Here's the facts. Yeah. What's going to happen to me? And again, I come back to advice, because nobody told me what really was going to happen. And I asked a lot of people.
Did they know?
I don't, boy, I don't know because, I don't think so. I don't think anybody had ever been through an enforcement action
Okay.
and told me there's different places that you can settle with the regulators. One is when they pre-file a litigation action against you, because most everything is non-public.
Uh-huh.
It's not in the public domain as they go through their investigation.
Mm-hmm.
So we were in that for a year. And during that time, you can settle with them. You can say, hey, let's get this out of the way. What do you want? And let's have a bad mark and whatever we need to do,
Yeah.
let's settle. Or if you can't settle, then they're going to litigate.
Yep.
And so I didn't know what those two zones were. Nobody really told me like, okay, you're in this zone now, and this is what you need to do. But if they litigate, then that's going to escalate it to another level, and then you're going to be in a completely different world.
Mm-hmm. And then that option of settling before litigation is no longer available.
That's right.
I mean, you must have, your advisors, whoever you are, you're terrible. I mean, they had to have known. Number one, if they didn't know, they should have known. And number two, if they didn't know, they shouldn't be in the industry in which they're operating, because that's seems obvious. Did you feel like some of your advisors or the people around you were trying to just give you good news and shield you from the potential bad news or outcome, which never do that? Don't hide the, what do they say? Address the elephant in the room is what I'm trying to, because I can't think of what I'm trying to say. Were they trying to protect you, or did they think by not sharing the worst outcome, which every entrepreneur knows, I need to know what the worst outcome is, and if you're hiding it from me, well, you're not any good to me as an advisor. Were they trying to, they're scared to tell you, or what was the situation?
I don't think so. I mean, everybody's human. Everybody makes mistakes. We all have this judgment when we're in it. The guy that we hired, he actually ran the SEC office,
Mm-hmm.
and he hired the guy that was the enforcement guy. So we had a really good relationship. He had a lot of internal knowledge. That's why we hired him. We were hoping that his relationships could really help us solve this. He just missed it.
Do you think it's possible that maybe his relationships did the opposite?
It could. I mean, you always look back and go, wow, that the circumstances and the set of things that happened to me would tell me that there was some behind the scenes
Bad blood or something.
There could be a payback. There could be something that had nothing to do with me, but
you got caught in the line of fire.
Yeah. I mean, but again, I look at it as if I wouldn't have done at the beginning, I would have never been there.
Mm-hmm.
And so that was on me.
Yeah.
And if I would have followed my gut and settled with them early on, I think we would have had a great outcome. The SEC was not interested, I think, in killing me. I mean, they had way, way, way bigger fish to fry.
Uh-huh.
They wanted definitely to chastise me and say, hey, we don't like that.
Mm-hmm.
But when I just was arrogant and
Yeah.
it was like, hey, I did nothing wrong.
Yeah.
We clearly made document mistakes. There was an appearance of they were not going to go away.
Yeah.
So my mistake was my own internal arrogance. And if I would have just owned it and said, hey guys, you guys are human, I'm human, how do we solve this? Oh my, it would have been, and I've done that in other areas where I've been hired to represent companies. I restructured a big company in town, and so now I always get the principals together. I kind of kick the lawyers out, and I have a very human conversation about what everybody needs and what the issues are. And oh my, we've saved, outcomes have been different. We've saved money. Lawyers don't like principals to talk.
They hate it.
They hate it. So anyway, I mean, that's
I should say bad lawyers don't like principals to talk. Good lawyers like principals to talk.
Yeah.
And what you said there, that's so important. And I don't know why it's missing. And it's the whole point of this podcast, the human side. Everybody is a human. It doesn't matter if you're Elon Musk. It doesn't matter if you're Michael Jordan. It doesn't matter if you're the president it doesn't matter who you are. And for some reason in our society, we tend to, for whatever reason, because of the size of their pocketbook or the political achievements or whatever the achievements are, we forget that's just a human. That is a human right there. And if you can look past all of the really non-important things, they've had tremendous success, great, we can learn from them. They've been financially successful, great. That doesn't mean that I want or should want anything that they've accomplished. I want to learn how they did it. But if you can just look at the human element, like you just described, you get principals in a room and you have a human conversation, the outcomes are 99 to, I would argue, probably 100% better than what they otherwise would be. Why do you think that doesn't happen more, Walter?
Well, I think professionals that have an agenda always want to shelter everybody. But when you get down and like, hey, here's what I need. What do you need? I just think you get to things, and whatever, if it's a relationship or a marriage or with your kids, when you're authentic and you take ownership from where you're at, whether it's in business, wherever it is, I just think people respect that. I think they react differently. I've gotten in a lot of trouble in my career going around attorneys and going to the principal and like, he can't do that and he shouldn't do that. And I do it anyway.
Good for you.
Because I know ultimately, what's going to happen. They're in protectionism and they're in fear. And a lot of times people don't do it because their advisors are like, hey, you can't do that because of these reasons. And I don't agree with that.
Yeah.
I just don't. It's not my strategy. It's not my philosophy. I like to get everybody in. And then once the principals are in the room and you can talk about things, then the lawyers can document it in a way, but the principal's always got to drive the transaction or the conflict or whatever it is that's there. When they're separate, there's distance, there's fear, there's unknowing, there's all kinds of things that enter into the equation that I don't think are productive.
So I want to jump back to the volatility that you experienced, even more going on than what I realized. How did you handle it? You said day by day, but that doesn't, I mean, there's still a tremendous amount of pressure on you at that point. What outlets did you have? How did you survive it?
So I've always been an activity person. So I did a lot of yoga. And so I did hot yoga during that time. And so hot yoga is an amazing thing because you go in this hot room and they just beat you up and you sweat. And then at the end, you do this, you lay down, it's called Savasana for a few minutes and your mind is somewhat clear. So there was so much chatter and there's so much thing that was going on and so many things that I needed to solve that it was just a very moment in time where I could be at peace.
Yeah.
And then that energized me to sort of kind of take it on the next day. You got to have some kind of outlet where you could be like, hey, everything's okay. And for me, it was kind of all geography. I lived in this big house and not the biggest thing. So I said, okay, what if all this goes? Then what? I still have my health. I still have my, my kids and
it
all
brings
that.
your priorities. That it helps you.
But the other thing too, that I think is super, super important for the high income earner, and what I missed is that when you're a 7-figure guy, 8-figure guy, you have a lot of variability of your income. When it's going up, you think you're never going to make less than the previous year. But the reality of it is when you hit the economic skids, your income will go down by 50%, by 80%.
Yeah.
You have to have the financial fortitude to be able to weather those economic storms, which will come.
Yeah.
They just absolutely, but if you're spending and your lifestyle is at a point in time. So for me, I knew that I was going through what's called a forced reorg. Some people go through a voluntary reorg. I went through a forced reorg. And I knew it was coming. I mean, I'm like, okay, it's this tsunami is coming, but I just, you check your ego at the door and say, okay, what can I learn? I mean, the hardest thing was when the SEC filed against me. I'll never forget. I was in Denver, and so I'm in Denver, and my lawyers call me, and they because we hadn't heard from them for, I don't know, a very long period of time, 6 months, 9 months, and I kept saying, hey, what's going on? What are they doing? Is there anything we need to be doing? They're like, no, they got other things going on. They may just drop it.
That's what your advisor told you. It's probably just going to go away.
No, they didn't say that.
Okay.
They said they may.
Okay.
Yeah, we just don't know.
Yeah.
Sometimes they get busy with other stuff. And so I said, so should we reach out? Should we? And they're like, no. And so then I get the call from the attorneys and they say, the SEC is notified us that they're filing an action on you today. And it's over. They're going to litigate. And before that, they had told me that they'll always give us what they call a last and final offer. Like, hey, take the, because we were negotiating back and forth and we just, we couldn't come up with something that worked. And so they had what they wanted and we had what we wanted. And so then there was silence. And so they kind of told me that, hey, they'll always give us a last and final, like, hey, this is the last offer on the table. Either take it or we're going to do this. But in my case, that didn't happen. And why that was, I have no, it always happens. And because the government doesn't want to litigate.
Yeah.
I mean, they don't want to spend the resources and they just don't want to do it. And
generally anybody who's been in that situation, I've been in that. You don't want to litigate. It's expensive for both sides. Even if you win, you lose. There's very rarely a positive outcome from litigation. I remember in the previous business, I had shared this, when Joe and I won in a settlement, we lost. I mean, you never win, even if you win. It's sad, but
yeah. So they called me that day, and so I went back to my hotel room, and I was just overwhelmed with, oh my. And so then I kept checking the internet. Like, am I going to hit the paper? So I kept checking the Arizona Republic. And so, I mean, I hit the Arizona Republic, and it was, the headline was investment advisor accused of fraud. Hit the Wall Street Journal. And
wow.
And so little guy. So that was really, that probably was that 45-day time frame when it seemed like everybody read the Republic that day. There wasn't anywhere I couldn't go, and they're like, "Hey, tough day the other day." And it's interesting the amount of friends you have when you're on the way up, but when this shit hits the fan, your friends get cut by
95%.
Yeah. You only have really a group that really hangs. It's really fascinating. I really experienced that, and but
they were never your friends then. So that's,
yeah. There's a lot of hangers on when things are going well.
So those 45 days you were saying were kind of the worst 45 days that you've experienced? Is that, professionally speaking?
It was horrific. So basically they filed, and I didn't know this. This is another thing of, I didn't know, that's the book, is like, it's the blind spot. It's not what you know that'll hurt you. It's what you don't know that will hurt you.
Famous quote from Donald Rumsfeld.
Yeah. And when it comes to money, making mistakes is 10x more painful than generating good returns. It just always is. So I teach mistakes. I don't teach how to generate returns. Returns take care of themselves over time. And it's the potholes. So what happened was, so then 2 days later, so they file, and I'm like, okay, I get my day in court. I feel comfortable. I'm gonna win. I get this letter in the mail 2 days after, and we had our client money in two places, Fidelity and TD Ameritrade. When you're an investment advisor, you have to have a place that holds your money.
They're in trust accounts, right?
Yeah, you're a custodian.
Yep.
And so we had this connectivity to the custodian. So Fidelity sends me a letter and says, "Hey, we noticed that the SEC is suing you. We're out. We're pulling your custodial plug." That was the second day. And then the third day, a friend of mine who actually helped me start my business, years earlier, was like the head of institutional trading for TD Ameritrade, called me and he said, "What happened?" And I said, "Pete, here's what happened. I'm gonna have a court date. I'm gonna win, and all this stuff." And he said, "I hate to tell you this, but I'm pulling the plug." So
you lost both of your custodial accounts. Where are you supposed to put these funds?
You're done. You're out of business. So if I would have known that, okay, here's another thing. So if I would have known, okay, if the government litigates you and there's unresolved litigation, custodians will not. They won't open an account with you. You're done. You have no place. Even
if you're innocent, they won't wait till resolution.
Correct.
If that litigation hits, which is why that step with SEC is such a big step. Yeah. That's good to know.
Yeah. So I actually wrote a white paper on kind of the experience, really, that I wanted to share with the community, anybody that's in an enforcement kind of scenario, what they're faced with. And the goal of that white paper is, you got to settle. Whatever it is that you've done wrong, whether you believe it's a little thing, a big thing, or whatever, you just got to settle with them and then move on. Litigation will, unless you're Mark Cuban litigated with the government and won. It was his insider training, but again,
he had the power and the resources.
Yeah, the power and the resources, and he wasn't an RIA, and so I was done. I was out of business in the fourth day. And so then, how am I going to generate revenue? How am I going to do it? We ended up figuring out how to do it. I got super creative with how to navigate that. But
so Oxford Investments at this point done.
Well, it was. But
you still had Family CFO, right?
No, Family CFO was started later.
Okay,
so that was all Oxford. And so I figured out how to do it. You get super creative, but it was a slog. It was a slog because I was labeled as a leper. Yeah. And so one of the things that we needed to have a new custodian is we needed this software connection. and there was maybe a dozen firms that provided a piece of software that we needed to connect to the custodians in a different way. And everyone we'd call, they go, oh yeah, we can help you with that. This is what we do. And then they go, oh, I noticed you're in litigation with the government and we can't touch you. I was radioactive. And that was really, really, really hard. Really, really, really hard. And so the avalanche of emotions of like, this just can't get any worse. Like this can't. And so I called 11 and 11 said no. And then finally one guy's like, I explained to him what happened. He goes, I'm going to help you. And so there was a bunch of like little miracles along the way that told me, as hard as it was, that just continue for another day. And so anybody that's going through that difficult time, they just need to understand that that's a gift or a token or something could be just on the other side of that. I can't believe it's, whether you lose a son, whatever the thing, whatever the thing was. And so there was one other thing that happened that just blew me away that kind of gave me the courage to also continue. So there's you have all those like little gems.
What's that other thing?
So we there's an iconic group in town, real estate company called Westcore Partners, and Westcore has developed all the malls, and they're just like this gold-plated organization. We've done a bunch of business with them. They sold back in 2001 to Macerich. Macerich owns all the malls now. And we were in the process of raising some money for them. And I was really transparent with them. I said, hey guys, I'm under this investigation with the SEC. It's non-public, but you guys need to know, because you guys are gold plated and I'm helping you do some other things. And I don't want to be that association. And they're like, hey, we're good. And when it hit the paper, all this stuff happened, and they called me maybe a couple weeks later and said, we need to see you. And I'm like,
here it goes.
Yeah, here's one more people that's going to start shooting at me. And Westcore's they've got like these 6 main partners, and they had junior partners, and again, they were just the best of the best. And I never met with all the partners at any one time, and it was this guy or maybe the junior guy, and we were working on some different projects. And so I walk into their big conference room, and all the main partners are there and the junior guys are there.
So this is a big deal.
Yeah. And I'm thinking they're just going to tattoo me. And I always get emotional when I talk about it, because it was the one thing that really told me that I was on the right path. And they just said, hey, we just want to let you know we believe in you. And what do you need from us? And it was like a show of, it was like a show of unity. And they didn't need to do that. Most people, when you get attacked, they want to duck and cover. They don't want anything to do with you. They're like, you're radioactive. We don't even want to know you. And we're going to deny that we knew you. And, they were the opposite. And those guys, I tell them to this day, that was probably the most significant day that I went there. And I said, I don't need anything from you guys. But just the fact that the main guys, and then the junior guys, and they were incredible. And that, and I think sometimes people stop, kind of right before that, because it's hard.
Yeah.
It's really, really, when you're in it and you're radioactive, and, it's really, really easy to quit.
Well, and people, I think people judge you immediately before hearing hits the paper, and there's automatic judgment there. And that's a huge testament to them, that the main partners took the time just to tell you. That's an awesome story. And I'm thankful that you shared it, because I think everybody, maybe not into the scale that you've been, life is tough, right? Everybody goes through ups and downs, and there are lows on the personal side, on the professional side. And what you said is, number one, what you get out of that is you'll find out who your real friends are. Number two, you'll find out who you are. You'll find out who you really are. The measure of a man or woman is not who they are in their best times. It's who they are in their worst times. And number three, just from a business perspective, just to hear that, like, Well, I'm a little bit speechless. So I can't really add any, because that's just, have you done business with them? Have you continued to stay in touch with them? To me, that just speaks volumes at why they're a gold plated organization, because what they're doing is focusing on the human. They looked at you as a human. Sure, we all make mistakes, and maybe there are circumstances where, you know, for financial reasons, risk reasons, an organization that wants to do business with you, they can't. That's a little bit different than in the scenario that you're describing. And I get custodians, but you didn't even get your day in court, and all the custodians pull the plug from you. And I get it. I'm not naive, but in a system where innocent till proven guilty, the reality is that's never what happens. The court of public opinion usually crucifies you before you even get the chance to have your day in court. And we're seeing that in today's day and age in so many different facets. So it's good to know that there are still people, even in business, that do take that approach, and that they took the time to say, we've heard this, we see you, we're there for you. Fast forward a little bit, you go through this time, you figure out how to regroup. And I think what you said is you just took one day at a time, which I think is sometimes really hard to do. But I'm a big believer in inch by inch life is a cinch, yard by yard life is hard. How did the next 1, 2, 3, 4 years transpire? And how did you eventually get the idea to start Family CFO?
So what happened was I mentioned that we were big real estate lenders.
Uh-huh.
And obviously that was a train wreck of a business. And so I'm going through the SEC stuff. And so a bunch of my clients got together and they're like, hey, we get all that SEC stuff. It doesn't matter to us. We know who you are. And oh, by the way, we've got a bunch of real estate that we're going to take back and we need to figure out what to do with it. And you're the only guy that can do it in such a way that will provide us the best outcome. And so we had, I don't know, 100, $120 million or just distressed stuff on the books. It was all individual properties. And so there was a whole bunch of different things and it had all kinds of hair on it and tentacles. And they knew if they were to bring in another group or something, it would just be, it'd be horrible. And it actually kind of came full circle because we had a development in San Francisco that wasn't going well. And we had a general partner that wasn't, let's just say he looked out for himself and not others. A very, very challenging guy. We had done a lot of business with. The one thing that's interesting is that you don't really know people's character until they're under pressure. Like everybody's great and honest and wonderful when the world's right, but when they're under pressure, you really see people in a different way. And I saw that in a bunch of different ways, good and bad, and mostly bad. Just because everybody saves themselves when things aren't going well. And that was a big lesson for me, is to understand that about kind of human nature. And because I always thought everybody's honest and they were going to do the right thing. And that's just not the case because they want to save themselves first. And so we had this project in San Francisco, by the way, the investor that the SEC said I took advantage of. She had a big position, millions of dollars in this particular investment. It wasn't going well. And so San Francisco was a very, very tough place to get anything. It was a condo development and lots of, complexities, but the market all of a sudden turned. And in 2014, we got a great offer. And first of all, we thought, okay, we're going to lose our, and then it was, okay, can we just get our money back? So my client said, hey, if I get my money back, that's a win. And so not only did the market move, but we got an offer for not only our money back, but a significant gain. But our general partner said, I don't want to sell. And I think it's worth more. And we're like, wait a minute, we're all the money. We're 100% of the capital. We want to sell. And he said, no. And so
did he have the power because of the bylaws to prevent?
He was the manager. So we got into litigation, and you can't sell something when you're in litigation. And so anyways, again, I understand personality. I understand how to kind of negotiate things. And so I ended up, and I figured out what he wanted, which was just holding us hostage for more money. And I said, what do you need to make this all go away? And the market in the city in 2014 was so hot that he said, well, I want $2 million.
For himself.
for himself.
What was his real motivation? Was he
He
going
just,
through a troubled time?
he's a difficult guy. Difficult guy. There was a lot of things.
Yeah.
That's a whole nother
Yeah, a whole
podcast.
nother podcast.
But he's going through a lot of things, and he was very vindictive, and he's on $2 million. And so I ended up going to the buyer, and I said, you got two choices. You know, we're not going to pay him because my guys hate this guy.
Mm-hmm.
But if you pay $2 million more, the property's worth $1 gazillion. I mean, they found something out about the property that we didn't know. They could get greater density and greater square footage. And when you get greater density and greater square footage, everything, the price. So I said,
especially in San Francisco.
Yeah. So I said, hey, if you guys want this to go to auction, you can be bidding against 10 other people, and who knows where the price is going to be. Or you can give me $2 million. We can solve this. We can close quickly, and it's yours. And so I convinced him to do that, paid that guy $2 million. But then this gal who the SEC said I took advantage of, we sent her $14 million. And
which was her original investment plus a lot more.
Yeah. And so she just was like, I'm so glad. She goes, I don't understand all that SEC stuff. She
Mm-hmm.
said, but I'm so glad I stuck with you. I'm so glad that, I just shut the noise off and let you, kind of do your job. And so that was like the full circle. That was from like start to finish. And then we had a bunch of, we had some good outcomes on some stuff we sold at a loss, but we just we rolled up our sleeves. And we just always told people what is. Yeah. Like, here's what we think. Here's what it's worth. Here's the good news. Here's the bad news. What do you want to do? Super transparent. And then everybody can, kind of make their own decision about, what we're doing and what we're not doing. And so we just facilitated that conversation with them, and we just kept everybody together. And the really cool thing about our group was nobody ever shot anybody else. Sometimes when you have partnerships and you have limited partners, they can be greedy and one can take advantage of another. And we never had any of that. We just had the best people and doing the things for all the right reasons. And sometimes they wouldn't agree and they'd say, well, whatever the collective group wants to do, I'll do that. Mm-hmm. And so that was very heartwarming in the midst of a lot of financial crisis and financial hardship and financial loss, that we still had people that were doing the right thing. So that was super cool. And so then after that, a couple of families approached me and said, hey, I really like what you do. And that's kind of how Family CFO, kind of started. And that's what we've been doing.
How can you know the test or the mettle of someone before seeing them go through something like that? And the reason I get asked all the time, and I ask a lot of my guests, business partners, no business partners, this is just applicable in personal relationships as it is in professional relationships. What advice would you give to someone who's trying to determine whether they should get into business with someone, or they're thinking about it, that will help them cut through the noise and see who the individual or individuals they're thinking about partnering with or doing a joint venture with or whatever it is, that can tell them, or that they can do, that can give them an indication of everything you've described you learned through your experiences about who someone really is?
It's really hard. I mean, it's really hard. I mean, I think a couple of things: you want to find a time in their lives where they were under significant pressure, and you want to really dive into how they reacted and what they did and decisions they made during that time. The other thing is there's an element that you just don't know. So you want to be able to detach from the mothership easily. And that's the mistake we made with the San Francisco project, is the ability to get a divorce was really, really hard. And so we advise people, we don't like partnerships, by the way, because our families are big enough to where
they don't need them.
Yeah. They want to go direct. And if they are co-investing with somebody, they have control. So there's those, we just try to avoid, because we know there's going to be an element of that. We're just not going to know. Mm-hmm. We're just not going to, we think we are, but you're not really going to know until you're really there. Yeah. And the more of the really big money that we talk to and network with, there's a gentleman in town that's a multi-billionaire, and he just says, listen, I do partner, but I have a ripcord that things don't go a certain way, then I can pull the ripcord and insert my team. Mm-hmm. You're out, I'm in. And he goes, that makes us feel a lot more calm. People walk into relationships and everybody's got rose-colored glasses. The life's wonderful. We're going to do great. We're going to make a lot of money. No, all these things. They don't really plan for, okay, what if we don't get along? How do we get divorced? How do we divide things up? How do we live together in conflict? And those are conversations that really need to happen. And one of the things that was really great, I really learned, I learned it, but the Google guy was very significant for me, because he's the smartest guy that ever came to my class, from his ability to see things. And he'd always focus on the negative. We talk about different things. And I said, Paul, you're always negative about everything. And he just said, yeah, he said, that's what I focus on. The good news always takes care of itself. But if I can navigate the negative and I can live with the negative, then I can live with everything else. People do the opposite. They always focus on the positive, and they don't think about the negative. So when they don't get the positive and then they're in the negative, they're like, I would have never done this. And so I always say, okay, if it doesn't work, how's it going to affect me? How am I going to be? What am I going to lose? All that. And so the marketing environment of Wall Street is it's just a commercial.
Yeah.
People don't know that they can lose, X amount of money or all of their money, or, all that stuff, like the FTX stuff. I mean, the crypto world. And, people just thought, okay, I'm just going to continue to compound my money and make a lot of money. They didn't realize, okay, this amount of money is completely at risk. Like, are you okay with, it could go up 10X, but it could go to 0. And if it goes, and there's a lot of people that, if it went to 0, it doesn't mean anything.
Yeah.
It doesn't affect them. But then there's also a lot of people that if it goes to 0, they're changing their lifestyle.
Yeah, I'm probably the majority. And, Sam Zell's got a great book, Am I Being Too Subtle? And he talks about everything for him was risk reward ratio.
Yep.
And he talks about a story where a group, they were looking at buying, I think it was radio stations, and they were telling all the positive. He said, what's my downside risk? That's all he cared about. And then the ultimate question is, okay, well, you can lose about this much. Okay, what's my upside risk? 50 times more. Okay, that's a risk reward ratio that makes sense. And that's
even in the firm. Like, if somebody would have said to me, so the other thing that I did, which was a big mistake, is the firm was just printing money, and I paid people wage income, meaning a market rate for what they were doing.
Yeah.
I needed to make people owners.
Needed to incentivize them differently.
Yeah. And you attract a different level of I had yes people that were working for me. I'm a kind of a visionary, and I'm quick to make decisions. I need these people that have heavy discernment to say, wait a minute, should we do that? What they would have discovered in that analysis, they would have said, okay, you can sell your firm to this client, but if you get it wrong, you lose everything. If you get it right, you get X amount of dollars. But do you still want to do that? That's a different conversation.
Completely different conversation.
Yeah. Are you willing to put it all on black?
Yeah.
And I think people need to have better conversations about risk return.
Yeah.
I just thought, can I do this? Yeah. Okay. Let's just do it. I just didn't see the chasm of what that is. And just people are just, so the book is kind of that odyssey of negativity of all that goes wrong.
So The Big Risk, we'll put a link in the show notes so that you can buy it on Amazon. Support Walter. The white paper he talked about, enforcement, we'll also put a link in the show notes. Walter, you've been incredibly gracious with your time. Before we conclude, we've covered everything. Thank you for being so open and sharing your life lessons with us. But is there anything else you want to share with us that you think would be particularly helpful?
Well, I mean, I just think as you summarize that I had so much guilt and shame around my failure. Reality of it is I went through a very public failure. Everybody goes through a failure, a mistake. If you're trying to do anything great, and you're moving at any kind of speed, you're going to do stupid, and you're going to do stuff that you're going to have regrets and shame. You gotta go beyond that. You got to look at it as like, okay, what do I learn from this, and how do I use this? So a follow on to this book is I'm writing a kid's book. It's not a kid's book, but it's how a parent can teach their kids about money. It's called 401 Kid. And it'll be out in,
I like that.
It'll be out but it's really
when will it be out?
We're probably 4 to 5 months away.
Okay.
We're about halfway through, kind of the process. But it's this thing that I hear all the time, that people come to my class and say, I wish I would have learned this earlier. And so parents really need to take a greater involvement, whether you come from financial means or not. in the education of what's possible in either the entrepreneurial world or the wage income. And so really it's just people, it's the failure's part of the journey. I mean, it's just, you're not going to avoid it. So once I really understood that, I kind of chuckled like, okay, mine was public. I hit the paper, and then you just got to keep going. Cause one of the things that is also interesting is because when you Google Walter Clarke, all the SEC stuff comes up. And so when people hire us now, some people hire us, some people don't.
Yeah.
And what's kind of fascinating about that is people come to me and say, hey, I got a PR agency. I can bury that on page 100 of the Google search. And I'm like, I'm not interested in that. It's part of my story. I lead with it. I tell people, hey, here's what happened to me. Here's why it matters. Here's how it affects you. So I think really the still is that like failure's is just a part of the process. So don't shy away from it. Use it as a stepping stone.
Yeah. And if you're anybody who hasn't failed, hasn't tried to do anything great, secularly speaking, that's just how it goes. And I love your mantra of don't try to bury that. That's who I am. Sure, we all make mistakes. And I think that's what I don't understand society. We're all human. We all make mistakes and we try to hide all those. That just makes you less authentic and less human. And if people are going to judge you for it, well, then you probably don't want them in your life anyways. If people know, they see it on there and like, hey, Walter, tell me about this. You talk it through, they give you a chance. Those are probably the people you want to work with.
Yeah.
So I think just that point that you made is something we can all learn from. Just if people are so focused that much on appearance, you can likely assume a lot of other things about what that person's intent or why they want to work together with you is.
Yeah.
Walter, this has been so incredible.
Great.
Thank you so much for joining us. Really appreciate it.
Okay.
Thank you for listening to the Andrew Holland Podcast. Never miss an episode by subscribing to and liking our YouTube channel, the Andrew Holland Podcast, and by following and liking the show on your favorite audio platforms. Be sure to connect with us on X, formerly Twitter, A Holland Podcast. That's A Holland Podcast. So you can interact with Andrew, the team, and our guests throughout the week. Thank you again so much for listening. Have a great day, and we'll talk again soon.